Corporate Finance Presentation. Internal Rate of Return, the IRR, the IRR. Get ready, it's time to take your chance with Corporate Finance. Internal Rate of Return, the IRR, or the IRR. No one really calls it the IRR like that, but it might help you to remember. I sometimes call it that. I think it's fun to say, even though it doesn't sound that great. But when you're thinking about the capital project, the capital decision-making process, the internal rate of return, the IRR, is one of the other fundamental calculations that you want to be taking into consideration. It's the other calculation along with the net present value, which should be the primary tools that pop into your mind. Remember that we're thinking about those types of projects that are going to have an impact into the future, multiple years into the future. The general plan to take those projects, break them down into a year-by-year category, and then think about our cash flow kind of calculations for them. We thought about the net present value calculation. Now we're thinking about the internal rate of return, which is the rate at which the net present value calculation would be zero. So the IRR measures investment profitability as a return percent, the rate at which the net present value calculation would equal zero. Now that sounds a little bit kind of confusing. Let's take a look at an example, and it's really helpful to just work multiple different examples. When you think about the internal rate of return, the internal rate of return is kind of related to the net present value. So you want to work those two calculations together so you get an idea of what the relationship looks like. So for example, if we had a project such as this, we have the initial investment going down. This is a typical type of project. That initial investment might be for something like equipment. It might be for inventory. It might be a project that we need an initial investment for. The reason we put the initial investment down being that we expect future cash flows over a year into the future. In this case, X1, year 1, 2, 3, and 4, 30,000, 32,000, 38,000, and 15,000. So now we want to think about whether or not this would be a project we take on or not. In the prior presentation, we thought about the net present value calculation, and we calculated the net present value with the discount rate, which might be the weighted average cost of capital. That's one of the primary calculations. That discount rate, of course, is crucial when we go through the decision-making process. If we were to use the discount rate and we came out to a bottom line number down here that was positive, zero or positive, that would mean that we had cleared the discount rate. If it was negative, we would be below the discount rate. So the general idea with the net present value is we will net present value the cash flows, outflows, and inflows using the present value calculations with regards to the discount rate, which means that the required rate of return is included in it. If we come up to something below zero, then we would not accept it because we're below the rate of return. If it's a zero or above, then we have met or cleared the rate and then might take on the project. Now, that's a great tool. However, there's a limitation because we can't really see how far above or below the net present value is. So, for example, if we had a net present value calculation based on the discount rate that was above zero, then we could say, okay, well, the higher the number, the better. If I was comparing two separate projects and I could only choose one, then I might choose the one with the higher number on it. That's usually better, although there could be circumstances where it would not be the case. But I don't really know the comparison on a percentage basis. So to get the comparison on a percentage basis, we can think about the internal rate of return. So the internal rate of return, in this case the 11.37, is the rate at which, if you were to do the net present value calculation, you result at zero. So that's going to be the return that's in there, the required rate of return. Now note, mathematically, this one's a little bit more confusing to calculate basically with a formula. So if you just apply algebra, but of course with a computer or financial calculator, it's going to be an easier thing to calculate. So you want to understand it theoretically, and then you want to be able to do it because it's very useful in practice. We're going to practice many problems with Excel going back and forth with the net present value and the internal rate of return. Also note that when you do it with something like a financial calculator or in Excel, it's easy to calculate but not really understand what it means. You can put a quick formula in there and then you don't really understand the relationship to the net present value. So you really want to understand how these two things are going to be put together. If you're taking test questions on it, then you got to understand kind of the theory behind it as well. So there's certain pros and cons to the net present value and the internal rate of return. The net present value has the limitation in that you only know that you cleared the hurdle rate or not with the net present value. So it's great for being able to see whether or not you cleared the rate or not. The bigger the number down here, the better. However, there could be circumstances when you're comparing projects that have different cash flows natures. For example, cash flows that have a different investment type or have significantly different amounts at the beginning or end of project, and cash flows that are longer in nature could result in some confusion with regards to the net present value calculation. In other words, if you're comparing two projects and one has a greater number with the net present value calculation than the other, it can be a little bit deceiving as to which would actually be better if there's substantial differences in, say, the investment, in the cash flows weighting on the beginning and end of the project, and different lengths in terms of how much you expect to receive in the future. The internal rate of return often is useful for that then. So often the scenario will look something like this. You calculate the net present value calculation. You determine, using the discount rate, you determine that it's a project that's over the discount rate. If it is, you cleared the discount rate. Then if you have multiple projects that you're kind of thinking about one or the other, and you have exclusive projects you need to put money in one project or the other, and they both clear the net present value, then you might want to calculate the internal rate of return to see the actual internal rate of return that would be received. Obviously, the higher the internal rate of return, then the better.